Before we jump in, it's crucial to state that I am not a licensed financial advisor, and this presentation is for educational and entertainment purposes only. The information provided in this video does not constitute financial, legal, or tax advice. Investing involves risk, including the potential loss of principal. Please consult with a qualified professional for advice tailored to your specific financial situation. Always conduct your own thorough research before making any investment decisions. There are over 100 million people in America who own a mutual fund. 100 million. And a shocking percentage of them, perhaps even you, are making a fundamental mistake that is quietly siphoning off tens, even hundreds of thousands of dollars from their retirement accounts. It's a silent killer of wealth, an invisible tax on your future. And the worst part is most people have no idea it's even happening. Think about it. You finally decide to get your financial life in order. You open your 401k or your IRA, and you're hit with a wall of options. It's an alphabet soup of ticker symbols: FXAIX, VTSAX, SWPPX, FCROX. It feels less like an investment platform and more like you're trying to decode a secret message. You see names like Growth Fund, International Blend, Aggressive Target Date 2060. So what do most of us do? We pick one that sounds good, maybe one our colleague mentioned or one with 5 stars next to its name, and we just hope. We set up our automatic contributions and hope we made the right choice. That feeling of confusion, of being overwhelmed, of just wanting to make a good decision but not knowing where to start. That is the gap where costly mistakes are born. And that hope for the best strategy is exactly what this is designed to eliminate forever. The goal here is simple: to pull back the curtain on the world of mutual funds, to expose the common traps and hidden fees that the industry doesn't want you to focus on, and to give you the clarity and confidence to invest intelligently. We are going to turn that confusion into power. By the end, you won't just be avoiding mistakes. You'll be making proactive, informed decisions that can fundamentally change your financial future. So let's get right into the single most common, most destructive, and most easily avoidable mistake people make with mutual funds: ignoring the expense ratio. If you only take one thing away from this entire discussion, let it be this: the expense ratio is the silent killer. It's the financial equivalent of termites in the foundation of your house. You don't see them, you don't hear them, but day after day, year after year, they are silently eating away at the structure of your wealth until decades later, you realize the damage is catastrophic. So what is it? In the simplest terms, the expense ratio is an annual fee that every mutual fund charges. It's expressed as a percentage of your investment. This fee covers the fund's operating costs, things like the fund manager's salary, marketing, administrative costs, all of it. And here's the critical part: this fee is automatically deducted from the fund's assets. You never get a bill for it. You never see it as a line item on your statement. It just disappears from your returns. If your fund earns 8% in a year, and it has a 1% expense ratio, you only actually see a 7% return. It's skimmed right off the top, whether the market goes up or down. Now you might be thinking, 1%? That sounds tiny. What's the big deal? And that right there is the trap. That is the multi-trillion-dollar illusion the financial industry is built upon. 1% doesn't sound like much. But over an investing lifetime, that tiny 1% can be the difference between a comfortable retirement and having to work an extra 10 years. Let's run the numbers, because this is where the blindfold comes off. Imagine 2 people, let's call them Sarah and Tom. Both are 30 years old. Both invest an initial $10,000 and contribute $500 a month for the next 30 years. Let's assume they both get an average annual market return of 7%. The only difference is the expense ratio on their chosen mutual funds. Sarah is smart. She's done her research. She invests in a low-cost S&P 500 index fund, something like VOO or FXAIX, with a tiny expense ratio of 0.03%. It's practically free. So her net return is essentially the full 7%. Tom, on the other hand, invests in an actively managed fund that was recommended to him. It has a much higher expense ratio of just 1%. Again, 1%. Seems harmless. This means his net return is only 6% per year. So what happens after 30 years? Sarah, with her ultra-low-cost fund, will have a portfolio worth approximately $675,000. A fantastic nest egg. Tom, with his seemingly small 1% fee, his portfolio will be worth about $573,000. Let that sink in. That 1% difference, that fee that seemed so insignificant, cost Tom over $102,000. $100,000 vanished. It didn't go up in a puff of smoke. It went directly into the pockets of the fund company. He paid a six-figure fee for the exact same market exposure, and he likely never even realized it. He worked for that money. He saved that money, and the termites of high fees ate it away year after year. That is the devastating power of compound costs. It works in reverse, and it is ruthless. The industry loves to justify these high fees. They'll tell you you're paying for expertise. You're paying for a brilliant fund manager, a team of analysts, a star stock picker who can beat the market. They create this mystique that their high-priced experts can navigate the choppy waters of Wall Street and deliver superior returns that will more than make up for their higher fees. Sounds compelling. It's a great story. But for the overwhelming majority of funds, it's a complete myth. The data on this is not ambiguous. It is brutal and conclusive. S&P Dow Jones Indices releases a report called the SPIVA Scorecard. It stands for S&P Indices versus Active, and it's the official report card for active fund managers. Year after year after year, it shows the same thing. The vast majority of actively managed funds fail to beat their benchmark index, like the S&P 500. Over a 15-year period, more than 92% of large-cap active fund managers underperform the S&P 500. Let me say that again. More than 9 out of 10 of these highly paid experts, who charge you that 1% fee for their skill, fail to do better than a simple cheap index fund that just mechanically buys and holds all the stocks in the market. You are paying a premium for a service that has a greater than 90% chance of delivering a worse result. It's like paying a celebrity chef $1,000 for a meal that has a 9 in 10 chance of being worse than a $5 hot dog. It makes absolutely no sense. So what's the solution? It's incredibly simple. First, become obsessed with expense ratios. Make it the very first thing you look for when evaluating a fund. You can find this number on any financial website like Yahoo Finance, Morningstar, or right in the fund's official prospectus. It's labeled clearly, expense ratio or gross expense ratio. Second, know what to look for. For a broad market index fund like one that tracks the S&P 500 or the total stock market, you should be paying next to nothing. Anything under 0.1% is good. Many of the best ones are under 0.05%. If you see an S&P 500 fund with an expense ratio of 0.5% or higher, run. It's a ripoff, plain and simple. For more specialized funds, you might pay a little more, but you should be extremely skeptical of any mutual fund charging over 0.75%. That 1% fee we used in our example isn't an exaggeration. It's common, and it's a wealth destroyer. By choosing low-cost index funds, you are not settling for average returns. You are mathematically guaranteeing yourself a greater share of the market's actual returns. You are opting out of the loser's game of trying to find that 1 in 10 manager who might beat the market, and instead you're ensuring that you keep what the market gives you. It is the single most effective way to put the power of compounding on your side, instead of letting it work against you. Check your 401k. Check your IRA. Check your brokerage account right now. Find out what you're paying. It's a 5-minute task that could literally save you $100,000. And once you've done that, once you've stopped the silent bleeding from high fees, you've plugged one of the biggest holes in your financial boat. But there's another leak, one that's far more seductive and honestly far more destructive for most people. It's not a slow, quiet drip. It's a massive, gaping hole that people willingly blast into their own portfolio, all while thinking they've discovered a secret treasure map. This is mistake number 2, and it's the single most powerful, most psychologically potent trap in the entire world of investing: chasing past performance. It's the shiny object syndrome of finance. We're all wired for it. We see something that's working, that's dazzling, and we want a piece of it. It's human nature. And the mutual fund industry knows this. They prey on it. They spend billions of dollars a year in advertising to make sure that the funds with the most spectacular recent returns are dangled right in front of your face. Let me tell you a story about a guy named Mark. Mark is smart. He's an engineer, detail-oriented, logical. He wouldn't buy a car without reading every review. And he'd spend a week researching the best dishwasher. But when it came to investing, he made a classic mistake. One day at work, his colleague Ben is bragging about a fund. Let's call it the Future Forward Tech Innovators Fund. Ben is up 80% in the last 6 months. He's talking about paying off his mortgage, about the genius fund manager, Catherine Jones, who's being hailed on magazine covers as the next investment oracle. Mark feels a pang of something. It's a mix of envy and anxiety. It's FOMO, the fear of missing out. His own 401k is just chugging along, making a respectable but boring 8 or 9%. He goes home that night and pulls up the Future Forward Fund. The numbers are intoxicating. The 1-year return is 152%. The 3-year average is 60% per year. The 5-year is 45% per year. The chart looks like a rocket ship taking off for the moon. It's a vertical line. He thinks to himself, this is it. This is the one. Why settle for 8% when I can get 152%? I'm smart. I can see a winner when it's right in front of me. All the logic he applies to buying a dishwasher goes right out the window. He ignores the fund's sky-high expense ratio, because who cares about a 1% fee when you're making 152%? He sees that little disclaimer at the bottom of the page, the one that says, past performance is no guarantee of future results, and he scoffs. He thinks it's just some silly legal thing lawyers make them put there. For this fund, for this manager, it's different. So Mark does it. He takes a huge chunk of his savings, money he was setting aside for a down payment on a house, and he plows it all into the Future Forward Tech Innovators Fund. Right at the top. For a few weeks, he feels like a genius. The fund ticks up another 3%. He's refreshing his brokerage account 10 times a day. But then the tide turns. The innovative tech stocks that the fund was packed with, the ones that had been priced for perfection, suddenly hit a wall. A bad inflation report comes out. The Fed hints at raising interest rates. The rocket ship sputters, it stalls, and then it begins to fall back to earth. First, Mark isn't worried. It's just a dip, he tells himself. A buying opportunity. But the fund drops 10%. Then 20%. The news articles that once praised the genius manager, Catherine Jones, are now questioning her strategy. The magazine covers disappear. Mark's 20% loss turns into a 40% loss. Then 50%. The money he was saving for his house has been cut in half. The panic is overwhelming. Every instinct in his body is screaming, get out. And finally, he does. He sells everything, locking in a devastating 55% loss. He takes what's left of his money and puts it in a savings account, vowing to never trust the stock market again. Mark's story is heartbreakingly common. He did what millions of people do every single year. He looked in the rearview mirror to drive his car forward. That disclaimer, past performance is no guarantee of future results, isn't just a legal requirement. It is the single most important and most ignored piece of wisdom in investing. Here's why. What Mark experienced is a phenomenon called regression to the mean. It's a fancy term for a very simple concept. Things revert to average. Think about a basketball player who has a career-defining season. He shoots an unbelievable 50% from the three-point line, way above his career average of 38%. He's on fire. He wins the MVP award. What do you think the odds are that he shoots 50% again the next season? They're almost zero. It's far more likely he'll regress or fall back, closer to his long-term average of 38%. Mutual funds work the exact same way. A fund that returns 152% in 1 year didn't do it because the manager found a magic formula. They did it because they made concentrated bets on a specific sector of the economy that got incredibly, unsustainably hot. They were in the right place at the right time. They had a career year. But that heat fades. The sector cools off. And the fund's performance regresses back to the average, and often far below average because the stocks they own are now wildly overvalued. The very success of the fund sows the seeds of its own destruction. When a fund like Future Forward posts those incredible numbers, money pours in. Mark's investment, along with billions from others just like him, floods the fund. This is a huge problem for the manager. Suddenly, she has to invest all this new cash. The small, nimble companies that drove her initial success are now too small for her to invest in without dramatically moving their stock price. So she's forced to buy larger, more well-known companies, the very same companies held by hundreds of other funds. The fund gets bloated, it loses its edge, and it starts to look just like every other average fund on the market, except it still carries that premium, star manager price tag. So what's the solution? How do you avoid the trap that snared Mark? You have to fundamentally change what you're looking for. Instead of looking at past performance, you need to look at the process and the philosophy. Don't ask, how much did this fund make last year? Ask, how did this fund achieve its returns, and is that process repeatable? Was it a disciplined strategy that has worked for decades through good times and bad? Or was it a lucky, concentrated bet on one hot trend? A lucky bet is not a strategy. It's a lottery ticket, and you don't build your retirement on lottery tickets. The real antidote to performance chasing is one of the most powerful and, frankly, simple ideas in finance. Instead of trying to find the one single basketball player who might get hot, you bet on the entire league. Instead of trying to find the one fund manager who might, against all odds, beat the market, you simply buy the entire market. This is the core concept behind an index fund. An S&P 500 index fund, for example, doesn't try to pick the best 50 stocks. It simply buys a tiny piece of the 500 largest companies in America. You're not betting on a single manager's skill or luck. You are betting on the long-term innovation, profitability, and growth of the American economy as a whole. Your focus shifts from the impossible task of predicting the future to the simple, powerful act of participating in the present. You accept the market's average return, which historically has been a fantastic way to build wealth. By doing this, you completely sidestep the emotional roller coaster of FOMO and panic that destroyed Mark's portfolio. You eliminate the guesswork. So I want you to look at your own portfolio. Do you own a fund simply because it had a great run a year or two ago? Did you buy it after seeing it on a top 10 funds of the year list? If so, you may have fallen into the performance chasing trap. It's time to reevaluate, not based on its dazzling past, but on its sober, repeatable process for the future. But this raises a critical question. If simply buying the whole market through a low-cost index fund is such a powerful and effective strategy, why do the thousands of other mutual funds even exist? Why are there legions of highly paid, supposedly brilliant fund managers actively trying to beat the market, especially when study after study shows that over any meaningful period of time, the vast majority of them fail? The answer is a multi-trillion-dollar secret the financial industry would prefer you didn't know about. And we are going to pull back the curtain and expose it in the very next part. The secret isn't some grand conspiracy hatched in a smoke-filled room. Simpler, more powerful, and far more profitable than that. It's a combination of two crushing forces that work against even the most brilliant fund managers. The first is a simple, unavoidable truth of mathematics. And the second is a fascinating paradox about the very nature of the stock market itself. Let's start with the math, because it's the easiest to understand. Imagine a professional runner. This runner is an Olympian, one of the best in the world. Now imagine telling this runner that in order to win the race, they not only have to beat all the other world-class athletes, but they have to do it while wearing a heavy backpack filled with rocks. Even for the best runner on earth, that's a tall order. Over a long enough race, that backpack is going to slow them down. They might have a good sprint here and there, but eventually the weight will take its toll and they'll fall behind the pack. In the world of mutual funds, that backpack is called fees. And every single actively managed mutual fund forces you, the investor, to run your race with that backpack on. The fund manager isn't just competing against the market. They are competing against the market plus the cost of their own fees. They don't just have to be average, they have to be better than average by at least the amount of their fees year after year, just to break even with the market. And what's inside this backpack? The biggest rock is something called the expense ratio. This is the percentage of your money that the fund company schemes off the top every single year to pay for everything: the manager's salary, the team of analysts, the fancy corner office, the marketing budget. It might sound small. You'll see numbers like 0.8%, 1%, maybe 1.5%. You might think, 1%? What's the big deal? Well, let's see what that 1% really costs you. Imagine two identical twins, Jane and Sarah. On their 30th birthday, they each receive an inheritance of $100,000. Both decide to invest it for retirement in 35 years. Jane, being a savvy viewer of this channel, finds a low-cost investment that tracks the overall market, and her annual fee is a tiny 0.04%. Sarah, however, gets persuaded by a smooth-talking advisor to invest in an actively managed mutual fund with a reasonable 1% expense ratio. The advisor tells her the manager is a genius who will surely beat the market. Let's assume both of their underlying investments earn the same exact return before fees. We'll say an average of 8% per year. They start with the same money, get the same market return, and invest for the same amount of time. The only difference is that tiny little 1% fee. Fast forward 35 years to their 65th birthday. Jane, with her ultra-low fee, checks her account. Her initial $100,000 has grown to nearly $1.44 million. A fantastic result. She's ready for a comfortable retirement. Now it's Sarah's turn. She opens her statement, expecting a similar result. But she's shocked. Her account balance is only about $1.03 million. She's more than $400,000 poorer than her identical twin. Where did all that money go? It was eaten year after year by that tiny 1% fee. It didn't just take 1% of her initial investment. It took 1% of her entire balance every single year for 35 years. That means it took 1% of her profits too. It was a silent parasite that feasted on her compounding growth, costing her nearly 30% of her potential nest egg. That is the devastating, wealth-destroying power of fees. And the expense ratio is just one of the rocks in the backpack. There are also trading costs. Active managers are, by definition, active. They're constantly buying and selling stocks, trying to find the next big winner. Every time they buy or sell, it incurs transaction fees, brokerage commissions, and other costs. These aren't usually listed in the expense ratio, but they come directly out of your returns. It's like the backpack has a small hole in the bottom, leaking sand with every step you take. So that's the first part of the secret. Fees create a mathematical hurdle that is almost impossible to clear consistently over the long term. But this is where it gets even more interesting. Even if there were no fees at all, most active managers would still fail to beat the market. And the reason why is the second, more paradoxical force: the market is just too efficient. What does that mean? Think of the US stock market as the world's biggest, most competitive prediction machine. On one side, you have millions of buyers. On the other, millions of sellers. And in the middle, you have hundreds of thousands of the smartest, most ambitious, and highest paid people on the planet. These are the active fund managers and their armies of analysts. They have PhDs from MIT, MBAs from Harvard. They work 80-hour weeks. They have access to supercomputers, proprietary data, and direct lines to company CEOs. Their entire job, their entire reason for existing, is to find a single piece of information that nobody else has, to find an undervalued stock before anyone else does. Now, here's the paradox: because there are so many of these brilliant people all looking for the exact same thing, any new piece of information, a good earnings report, a new product announcement, a shift in the economy, gets discovered and priced into a stock's value almost instantaneously. It's like a massive global gold rush. If one person secretly discovers a huge vein of gold, they can get rich. But if 10,000 brilliant gold prospectors with advanced geological mapping technology are all searching the same small valley, the moment one of them finds a nugget, everyone else swarms the location. Within minutes, the advantage is gone. The gold is found, and its value is now known to everyone. The stock market is that valley. The fund managers are the prospectors. They are so good and so numerous that they cancel each other out. They make the market incredibly efficient at pricing in all available information. This means that at any given moment, the current price of a stock is likely a very fair and accurate reflection of its true value based on everything that is publicly known. Trying to consistently find mispriced stocks in that environment is like trying to find a $10 bill on the floor of Grand Central Station during rush hour. Sure, one might exist, but it'll be picked up in a nanosecond. So, the very people who are trying to beat the market are the ones who make the market so hard to beat. It's a beautiful self-correcting, and for them, self-defeating system. As a group, all of these active managers essentially are the market. Their collective buying and selling is what sets the prices. Therefore, for every active manager who makes a brilliant trade and beats the market average, there must be, by definition, another active manager on the other side of that trade who underperforms the market average. It's a zero-sum game. Before any fees are taken out, about half of managers will beat the market, and half will lose to it purely by chance. But then you add the backpack. You reintroduce the fees. You take that 50-50 proposition and you subtract the guaranteed cost of the expense ratios and the trading costs. And suddenly the odds flip dramatically against you. The 50% chance of winning drops to 40%, then 30%, and over long periods of time it drops to less than 10%. This is the multi-trillion-dollar secret. It's not that fund managers are stupid. It's that they're trapped in a game that is mathematically rigged against them. They're playing on hard mode with a handicap, in a league where everyone else is an all-star. They have to be smart enough to outwit hundreds of thousands of other geniuses, and they have to be so spectacularly right that their wins are big enough to cover the guaranteed drag of their own fees. It's a broken model. A losing proposition for the person whose money is actually on the line, you. So if betting on these star managers, these supposed market wizards, is a proven losing strategy, what's the alternative? Where are you supposed to put your money to give yourself the best possible chance of success? It turns out the answer is stunningly simple, and it comes from some of the greatest investing minds in history, including Warren Buffett. There is a better way, and we are going to dive into exactly what it is and how you can use it in the very next part. The solution, the elegant answer to escaping the high-fee, underperforming trap of most mutual funds, isn't some complex new strategy. It's a philosophy. It's a revolution that started over 50 years ago, and its champion was a man Wall Street initially laughed at. His name was John C. Bogle, and his idea was so profoundly simple, yet so powerful, that it would go on to change the world of investing forever and make millions of average people wealthy. Imagine you're at a giant county fair, and the main event is a pie-eating contest. There are 100 contestants, all claiming to be the best. You have to bet on who will win. You could spend all day studying them. You could analyze their past performances, check their training regimen, interview their coaches. You might get lucky and pick the winner, but more likely you won't. You'll pick someone who looks promising but chokes halfway through. Or you'll pick last year's champion, who just doesn't have it today. This is active fund management. It's the stressful, expensive, and often disappointing game of trying to pick the winners. But what if there was another way to bet? What if, instead of betting on a single contestant, you could place a single tiny bet on every single contestant in the race? You wouldn't get the thrill of picking the one long-shot winner, but you would be absolutely guaranteed to have a piece of the champion, whoever it turns out to be. You're no longer betting on a single person. You're betting on the contest itself. This is the beautiful, world-changing idea behind the index fund. An index fund doesn't have a star manager making brilliant trades. It doesn't have a team of analysts searching for hidden gems. It has one humble job: to buy and hold every single stock in a given market index, like the S&P 500, which represents the 500 largest companies in the United States. It simply buys the entire haystack instead of trying to find the needle. Its goal isn't to beat the market. Its goal is to be the market. And by doing so, it guarantees you the market's return. Now you might be thinking, that sounds average. Why would I want to settle for average? And that is the multi-trillion-dollar question. The answer lies in two devastatingly simple truths. First, costs. Remember those expense ratios we talked about? The 1 or 2% that high-paid managers charge to try and beat the market. An index fund doesn't need a high-paid manager. It doesn't need a fancy office on Wall Street. It's run largely by computers programmed to do one simple thing: own the index. As a result, its costs are breathtakingly low. We're not talking 1%. We're talking fractions of a percent, often as low as 0.04% or even less. Let's put that into perspective. A 1% fee on a $100,000 portfolio is $1,000 a year every year. A 0.04% fee is just $40. Over 30 years, that difference isn't just a few $1,000s. With the power of compounding, that 1% fee can devour nearly a third of your potential nest egg. A third. All siphoned away not by bad market performance but by fees alone. The index fund plugs that leak. Keeps that money in your pocket working for you. The second reason index funds win is even more profound. It's the simple fact that, as a group, the experts just aren't that expert. Think about it. The market is simply the average of all investors, including all the brilliant, highly paid professionals at Goldman Sachs, Morgan Stanley, and every hedge fund in Manhattan. For every professional manager who sells a stock because they think it's going down, another professional manager has to be on the other side, buying that same stock because they think it's going up. They can't both be right. For one manager to beat the market average, another manager must, by definition, lose to the market average. It's a zero-sum game. But here's the catch. It's a zero-sum game before fees. Once you subtract the high fees those managers charge for playing the game, their collective performance is guaranteed to be less than the market average. By simply buying the index fund, you sidestep this entire expensive losing game. You take the market's return minus a tiny, almost negligible cost, and you end up ahead of the vast majority of the pros who are churning their accounts and charging a fortune to do it. This isn't just a theory. It's been proven time and time again. And the most famous proof came from the master himself, Warren Buffett. In 2007, Buffett issued a public challenge. He wagered $1 million of his own money that a simple, unmanaged, low-cost S&P 500 index fund would outperform a hand-picked selection of hedge funds over the course of 10 years. Now, remember, hedge fund managers are the supposed masters of the universe. They're the best of the best, the smartest guys in the room, charging astronomical fees for their genius. A company called Protégé Partners accepted the bet. They carefully selected 5 of the best hedge funds they could find to go up against Buffett's boring old index fund. The race began right before the 2008 financial crisis. For the first year, the hedge funds did better, losing less than the index fund. The experts were gloating, but Buffett remained calm. He knew the power of his simple strategy was a marathon, not a sprint. And then the comeback began. As the market recovered, the index fund chugged along, capturing the full return of American business. The hedge funds, with their frantic trading and massive fees, started to lag. And then they lagged some more. By the time the 10-year bet concluded at the end of 2017, the results weren't just a win for the index fund. It was a complete and utter annihilation. The S&P 500 index fund had returned an average of 7.1% per year. The hand-picked portfolio of genius hedge funds? They returned a pathetic 2.2% per year. Let me say that again. 7% versus 2%. Over the decade, a $1 million investment in the index fund would have grown to over $2 million. The same investment in the hedge funds would have barely grown at all. Buffett easily won the bet and donated the winnings to charity. The lesson is one of the most important in all of finance. The single biggest mistake an investor can make is to believe that the key to success is finding a brilliant manager who can outsmart the market. That is a siren song that has led millions of investors onto the rocks of high fees and chronic underperformance. The truth is, for the vast majority of us, the path to wealth isn't about finding the smartest person in the room. It's about admitting that the room itself, the entire market, is smarter than any single person within it. So the fourth major mistake to avoid when learning about mutual funds is this: chasing performance and paying for expert stock pickers, when a simple low-cost index fund is statistically proven to be the superior choice over the long term. It's choosing to play a game that is rigged against you. John Bogle, the founder of Vanguard and the father of the index fund, called his idea the triumph of common sense. He faced decades of ridicule from the Wall Street establishment, who called his idea un-American, and nicknamed his first fund Bogle's Folly. Why? Because it threatened their entire business model, which was built on convincing you that you needed them. But Bogle's Folly is now a multi-trillion-dollar industry that has saved investors billions, perhaps trillions, in fees, and has become the default investment choice for the most successful investors in the world, including Warren Buffett. It's the ultimate financial democratization. You don't need a secret password or an inside connection. You can, with a few clicks of a button, own a piece of the 500 greatest companies in America and share in their long-term growth and prosperity, all for a cost that is next to nothing. The secret is out. The answer seems simple. Just buy an index fund. Case closed, right? Not quite. Because walking into the index fund store is like walking into a supermarket. There isn't just one option on the shelf. You'll see S&P 500 funds, total stock market funds, NASDAQ 100 funds, international funds, bond index funds. The list goes on. Choosing the right type of index fund is the crucial next step. And making the wrong choice here, picking an index that doesn't align with your goals or risk tolerance, can be a subtle but incredibly costly mistake. Is owning the top 500 companies enough? Or should you own the entire US stock market, including the small and mid-sized companies? How you answer that question has a massive impact on your financial future. And we're going to break down exactly how to make the right choice in the next part. So let's settle the big debate. The heavyweight championship of index funds. In one corner you have the reigning undisputed champion, the household name, the S&P 500 Index Fund. It holds the 500 largest, most established companies in America. Think of it as the starting lineup of the US Olympic Dream Team. The Michael Jordans, the LeBron Jameses of the corporate world. In the other corner you have the challenger, the quiet giant, the Total Stock Market Index Fund. This fund doesn't just hold the 500 starters. It holds the entire league. It owns the stars, the solid role players, the scrappy underdogs, and the promising rookies. It owns all 3,000 plus publicly traded companies in the United States, from Apple all the way down to a tiny tech startup you've never heard of. The common mistake isn't necessarily picking one over the other. Both are phenomenal, low-cost ways to invest. The mistake, the one that trips up millions of people, is not understanding the profound difference between them. It's seeing their charts move in a similar direction and thinking, they're basically the same thing. I'll just go with the famous one. This seemingly small misunderstanding can lead you to build a portfolio that is less diversified and has potentially lower long-term growth than you think. You're unintentionally making a concentrated bet without even realizing it. Let's break this down. The most crucial thing to understand is that the S&P 500 companies make up about 85% of the value of the total stock market fund. This massive overlap is why their performance looks so similar day to day. When you buy a total stock market fund, you are, for the most part, buying the S&P 500. But you're also getting something extra. You're getting that other 15%. And that 15% is where the game is changed. That 15% is composed of thousands of mid-sized and small-sized companies. These are not the lumbering giants of the S&P 500. These are the agile, innovative, and often faster-growing companies that are the engine of the American economy. Think about it logically, which is easier? For Apple, a $3 trillion company, to double in size to $6 trillion? Or for a promising $5 billion biotech company to double to $10 billion? The law of large numbers is at play. Smaller companies, by their very nature, have more room to run. They are the potential Amazons and Teslas of tomorrow. By investing only in the S&P 500, you are explicitly excluding this entire segment of the market. You are, in effect, saying, I believe all the future growth and innovation in America will come only from the 500 biggest companies that are already on top. Does that sound like a bet you want to make for the next 30 or 40 years? History would suggest that's a risky proposition. The list of the top companies is constantly changing. Companies that were giants decades ago are footnotes today. The total stock market fund automatically captures the winners as they rise. As a small company grows and becomes a mid-sized company, and eventually a large company, a total stock market fund is holding it every step of the way. An S&P 500 fund only buys it after it has already become a giant, potentially missing out on its most explosive phase of growth. This brings us to the second critical advantage: diversification. We're taught from day one that we shouldn't put all our eggs in one basket. Yet, by choosing the S&P 500, many investors are putting their eggs in a slightly smaller, more concentrated basket than they need to. While 500 companies sounds diversified, and it is, owning over 3,000 companies is by definition more diversified. It spreads your risk across a much wider array of businesses in different stages of their life cycle. There have been long periods in history where small company stocks have significantly outperformed large company stocks. During the decade from 2000 to 2009, for instance, the S&P 500 actually produced a negative return, while small-cap stocks delivered positive gains. If you only owned the S&P 500, you lost money for a decade. If you owned the whole market, that small-cap exposure helped cushion the blow. Conversely, in the decade that followed from 2010 to 2019, large-cap tech stocks were on an absolute tear, and the S&P 500 slightly outperformed the total market. The lesson here isn't that one is always better. The lesson is that we have absolutely no idea which segment, large, mid, or small, will be the winner over the next decade. The smartest people on Wall Street can't predict it. So why should you or I even try? The mistake is thinking you have to pick a winner. You don't. You can own them all. The total stock market fund is the ultimate admission of humility. It's saying, I don't know which companies will be the stars of tomorrow, so I'm just going to buy the entire stadium and guarantee I own the winners, whoever they turn out to be. The legendary founder of Vanguard, Jack Bogle, who invented the index fund, was a huge proponent of this philosophy. While he often used the S&P 500 as a great example for its low cost and simplicity, his core philosophy was to buy the entire haystack, rather than trying to find the needle. The total stock market fund is the purest expression of that idea for U.S. stocks. It's simple, it's incredibly diversified, and it captures the full return of the American enterprise, not just a slice of it. So what does this mean for you? If you currently own an S&P 500 fund, don't panic. You haven't made a terrible mistake. You own a fantastic, world-class investment that has built incredible wealth for millions of people. It's a great choice. But a total stock market fund might just be a slightly greater one. Completes the picture. It's a more robust, more diversified, and more theoretically sound foundation for a long-term portfolio. It's the difference between owning the all-star team and owning the entire league. Both are amazing, but one gives you a broader claim on all future success. The real mistake we're trying to avoid here is one of unintentional concentration. It's the mistake of thinking you're fully diversified in the US market when you're actually missing thousands of companies. It's making a silent, implicit bet that the biggest companies of today will continue to be the biggest drivers of growth tomorrow. By simply swapping an S&P 500 fund for a total stock market fund, you eliminate that bet. You take one more piece of guesswork out of the equation, allowing you to simply own the market in its entirety and let the power of capitalism do the heavy lifting for you. You've now built a powerful foundation. You've decided to own every publicly traded company in the most powerful economy on Earth. You've avoided the trap of concentrating on just the big guys. But in doing so, you might be walking straight into an even bigger, more consequential mistake. A mistake of geography, a mistake of home country bias. Because what if the next Apple, the next Amazon, the next revolutionary company that changes the world isn't American? By focusing only on the US, you're ignoring over 50% of the world's stock market opportunities, forgetting that the rest of the world exists as one of the biggest and most common portfolio sinkholes. And we're about to show you exactly how to avoid it. Let's travel back in time for a second. It's the late 1980s. The Walkman is king, hair is huge, and the global economy has an undisputed champion, Japan. The Tokyo stock market, the Nikkei, was on an absolute tear. It seemed unstoppable. Japanese companies were buying up iconic American assets like Rockefeller Center and Columbia Pictures. Financial experts and media headlines were all saying the same thing. The 21st century would be the Japanese century. Investing anywhere else seemed foolish. An American investor back then, looking at the data, would have been sorely tempted to pour all their money into Japanese mutual funds. They were the clear winner. And then it stopped. The bubble burst in 1990. The Nikkei index plummeted and entered what is now famously known as the lost decade, which then stretched into 2 lost decades, and then 3. To this day, more than 30 years later, the Nikkei has still not reclaimed its 1989 peak. Imagine being that investor who bet everything on the obvious winner. Your retirement dreams would have been completely and utterly decimated. This isn't just a history lesson. It's a critical warning. What Japan was in the 1980s, many people feel the United States has been for the last decade. The S&P 500 has delivered incredible returns, and it's easy to fall into the trap of thinking this dominance is permanent. But history shows us that no single country stays on top forever. Leadership rotates. The winning economy of one decade is often the laggard of the next. So, how do you avoid this catastrophic mistake? You build a portfolio that's ready for anything. You don't try to predict the winner. You own a piece of all the contenders. You do this by investing in international mutual funds. Now, this is where a lot of people get overwhelmed. The world is a big place. Where do you even start? Let's break it down into simple, manageable pieces. Think of international funds as falling into 2 main categories. First, you have developed markets funds. These funds invest in companies from stable, wealthy, industrialized countries outside the US. Think of places like Germany, the United Kingdom, France, Japan, Canada, and Australia. These are the blue-chip nations of the world economy. Investing here gives you exposure to mature, profitable companies. It's generally considered less risky than our next category, but it's a crucial piece for stable, long-term growth. You're tapping into different economic cycles, different consumer bases, and different industry strengths than what you find in the US alone. Second, and this is where it gets really interesting, you have emerging markets funds. These funds focus on countries with rapidly growing economies that are still in the process of industrializing. We're talking about nations like China, India, Brazil, Taiwan, and South Korea. This is the high-growth, high-octane part of your international portfolio. These economies are expanding at a much faster pace than the developed world. They have younger populations, a rising middle class with growing spending power, and massive potential for innovation. Of course, with great potential comes greater risk. These markets can be more volatile. They face more political uncertainty and their currencies can fluctuate wildly. But for a long-term investor, dedicating a slice of your portfolio to emerging markets is how you capture the explosive growth that will likely power the global economy for decades to come. So you have 2 main tools: developed markets funds for stability and emerging markets funds for growth. You can often buy these separately. For example, you could buy a total international stock market index fund, which often bundles both developed and emerging markets together, excluding the US. Or you could get more granular, buying a developed markets fund and a separate emerging markets fund to have more control over your allocation. There's also a third type you'll see called a global or world fund. Be careful with the terminology here because it's a common point of confusion. An international fund almost always means everywhere except the US. A global fund, on the other hand, invests everywhere including the US. For a brand new investor, a global fund can be a simple one-stop shop, but for most people building a portfolio, you'll want to buy your US and your international funds separately to have a clear picture of exactly how much you have invested at home versus abroad. This brings us to the million-dollar question. How much? How much of your stock portfolio should you actually dedicate to these international funds? If you ask 10 different financial advisors, you might get 10 different answers. But we can look to the pros for a very solid starting point. Let's look at what the giants do. Vanguard, one of the biggest investment companies in the world, designs their wildly popular target date funds to be a set-it-and-forget-it portfolio for millions of Americans. And how do they allocate? In their stock portion, they consistently put 40% into international stocks and 60% into US stocks. Let that sink in. They believe a properly diversified portfolio for the average American should have nearly half of its stock exposure outside of the United States. Fidelity, another giant, has a similar approach, often hovering around that 30 to 40% international mark. The general consensus among most financial planners is that a meaningful international allocation for a U.S. investor is somewhere between 20% and 40% of your total stock holdings. Anything less than 20% and you're not really getting the full diversification benefit. You're just dipping a toe in the water. Anything more than 40% or 50%, and you might be taking on more currency risk and volatility than you're comfortable with, especially since as a U.S. investor, your future expenses will be in U.S. dollars. So a fantastic no-nonsense starting point is to aim for an 80-20 split. 80% in U.S. stock funds, 20% in international stock funds. As you get more comfortable, you can gradually increase that international portion toward 30% or even 40%. Within that international slice, you could start with a simple all-in-one international index fund. Or you could decide to split it, for example, putting 3/4 of it in a developed markets fund and 1/4 in an emerging markets fund. This would give you broad global exposure with an extra little kick of growth potential. Now, how do you choose the right international mutual fund? You use the exact same principles we've been talking about. The number one factor is cost. Look for funds with a low expense ratio. Because you're dealing with foreign markets, some of these funds, especially actively managed ones, will try to charge you an arm and a leg. Don't fall for it. There are dozens of fantastic, low-cost international index funds that will give you all the diversification you need without a hefty price tag. An expense ratio below 0.2% is great. Anything approaching 1% is a giant red flag. This brings up the active versus passive debate. There is an argument that in less efficient emerging markets, a skilled active manager might be able to find hidden gems and outperform the index. And while that might be true for a select few, the data overwhelmingly shows that, over the long run, the vast majority of active managers fail to beat their benchmark index, especially after you account for their much higher fees. For 99% of investors, the most reliable and cost-effective path is to stick with a low-cost, broadly diversified international index fund. It's simple, it's cheap, and it ensures you own a piece of thousands of companies all across the globe. By doing this, you're not just investing, you're building a financial fortress. You're insulating yourself from the fate of any single country. If the US market has a lost decade like Japan did, your portfolio won't be completely wiped out, because your investments in Europe and Asia will be there to pick up the slack. And if an emerging market economy absolutely explodes with growth, you'll be right there to benefit from it. You stop being a speculator trying to guess the next winner and become a true global investor, profiting from human ingenuity and economic growth, no matter where on the planet it happens to be. This is one of the most powerful mindset shifts you can make as an investor. But even with the perfect global allocation, there's another, more insidious mistake that can drain your returns without you even realizing it. We've talked about what to buy and where to buy it, but we haven't focused on the single biggest destroyer of wealth in the mutual fund world. It's not a bad stock pick or a market crash. It's the slow, silent bleed of money from your account. And in the next part, we're going to uncover the hidden fees that are secretly eating away at your future and show you how to stop them for good. These fees are financial termites. You don't see them, you don't hear them, but they are silently, relentlessly chewing away at the foundation of your financial future. By the time you notice the damage, the structure is already compromised, and a huge portion of what should have been yours has been turned to dust. We're told that fees are just the cost of doing business, a small price to pay for professional management. This is one of the most dangerous half-truths in the entire financial industry. The truth is, the fees you pay are the single most reliable predictor of your future investment returns. Let me say that again, because it is the most important sentence you might hear about investing this year. The fees you pay are the single most reliable predictor of your future investment returns. Not the genius of the fund manager, not the fund's 5-star rating, not its past performance. It's the cost. The king of all these wealth-destroying fees is the expense ratio. The expense ratio is the annual fee that all funds charge, expressed as a percentage of your investment. It covers the fund's operating costs, like the manager's salary, administrative staff, marketing, and office space. It's automatically deducted from the fund's assets, so you never even see it leave your account. Just disappears. A 1% expense ratio might not sound like much. 1%. What's the big deal? It's the difference between retiring comfortably and working an extra decade. Let's run the numbers. Imagine two friends, Sarah and Mike. Both are 30 years old and they each invest a lump sum of $10,000 for their retirement. They don't add another penny. They just let it grow for the next 35 years until they turn 65. Let's assume the market gives them both an average annual return of 8%. Sarah goes to a traditional financial advisor who puts her in a popular, actively managed mutual fund. It has a great track record, a well-known manager, and what seems like a reasonable expense ratio of 1.5%. Mike, on the other hand, does his own research. He chooses a simple, low-cost S&P 500 index fund. His fund has a tiny expense ratio of just 0.05%. For the first few years, the difference is barely noticeable. After 5 years, Sarah's account is worth about $14,000. Mike's is worth about $14,600, a $600 difference. No big deal, right? But the termites are just getting started. The power of compounding, which is supposed to be your greatest ally, is now working for the fund company. Let's fast forward. At age 65, after 35 years, Mike's $10,000, with a tiny 0.05% fee, has grown to a staggering $141,000. He turned 10 grand into a small fortune by doing absolutely nothing. What about Sarah? That small 1.5% fee has been silently devouring her returns year after year. Her final account balance is $93,000. Let that sink in. They invested the exact same amount of money in the exact same market and got the exact same 8% gross return. The only difference was the fee. That 1.45% difference in the expense ratio cost Sarah $48,000. That's nearly 5 times her initial investment, vanished into thin air. It was transferred dollar by dollar, year by year, from her retirement account into the pockets of the fund company. Now, imagine if they were investing a few $100s every single month. The difference wouldn't be $48,000. It would be hundreds of thousands of dollars. It's the difference between a retirement of freedom and a retirement of financial anxiety. That is the devastating power of the expense ratio. But wait, there's more. The expense ratio is just the main course. There's a whole appetizer menu of other fees designed to trip you up. And the next one is even more blatant. It's called a sales load. A sales load is just a fancy word for a commission paid to the broker or advisor who sold you the fund. There are 2 main types. First, the front-end load. This is a fee you pay the second you invest your money. Let's say a fund has a 5% front-end load. You decide to invest $10,000. You hand over your check, and what happens? Only $9,500 actually gets invested. The other $500 goes directly into the salesperson's pocket. It's gone. Before your money has even had a chance to earn a single penny, you're already down 5%. You are starting a marathon a mile behind the starting line. It is almost impossible to justify paying a front-end load in today's world when there are thousands of fantastic, no-load funds available. The second type is the back-end load, also known as a contingent deferred sales charge, or CDSC. This one is sneakier. They tell you, there's no upfront cost. 100% of your money goes to work for you from day one. Sounds great, right? The catch is, if you sell the fund within a certain period, usually 5 to 7 years, you get hit with a penalty fee. It might be 5% if you sell in the first year, 4% in the second, and so on. This is a trap. It's financial quicksand. They are locking you into their fund, even if it performs terribly. You might realize after 2 years that the fund is a dog, but the thought of paying a 4% penalty to get your own money back is sickening. So, you stay put, hoping it will turn around while the fund continues to underperform and that high internal expense ratio continues to eat away at your returns. It's a double whammy of bad performance and high costs, wrapped in a penalty that prevents you from escaping. And if you think that's all, there's one more insidious little fee I have to tell you about, often buried inside the expense ratio itself. It's called a 12b1 fee. This is a fee that the fund charges you to pay for its own marketing and advertising. You are literally paying them to run TV commercials and create glossy brochures to attract new investors. How does a commercial to attract someone else help your investment grow? Doesn't. It is a direct drain on your returns for zero benefit to you. It's like going to a restaurant, paying for your meal, and then getting a second bill to help pay for the restaurant's billboard on the highway. It's absurd. So how do you avoid this minefield of fees? How do you find the good funds and avoid the wealth-destroying parasites? It's actually much easier than you think. You don't need a finance degree. You just need to know where to look. Every single mutual fund in the United States is required by law to publish a document called a prospectus. It looks intimidating, full of legal jargon, but you only need to look for one thing: the fee and expense table. It is always near the very beginning. This table is your secret weapon. It legally has to list every single fee in plain English. Look for the word sales load as a % of offering price. If you see any number there other than 0 or the word none, close the document and run away. You want no load funds. End of story. Next, find the line that says total annual fund operating expenses, or simply expense ratio. This is the magic number. Your goal is to get this number as low as humanly possible. What's a good number? For a basic stock index fund, anything under 0.1% is great. Anything over 0.25% should be viewed with extreme suspicion. For an actively managed fund, you might see higher fees, but if you're paying over 1%, you better be getting some truly spectacular world-beating performance, which historical data shows is incredibly unlikely over the long term. Your mission, should you choose to accept it, is to go look up the expense ratio for every single mutual fund you own. In your 401k, in your IRA, in any brokerage account. Find that number. If it's high, you are lighting money on fire every single day. You now have the knowledge to put out the fire. By simply switching from a high-cost fund to a low-cost alternative with the exact same investment style, you can add tens, or even hundreds of thousands of dollars to your future net worth. This is the single biggest and easiest optimization you can make to your entire financial life. But now that you've plugged the leak and stopped the silent bleed of fees, there's another more seductive trap that almost every new investor falls into. It's an illusion, a siren song that promises incredible riches, but almost always leads your portfolio to crash against the rocks. And it all comes from looking in the rearview mirror. The eighth mistake is perhaps the most common, the most intuitive, and the most financially destructive of them all. It's the mistake of chasing past performance. It's the belief that the key to your future wealth is found by looking at a fund's 1-year, 3-year, or even 5-year return number, and assuming that same trajectory will continue skyward forever. It's the equivalent of driving your car at 80 miles an hour down the highway by staring exclusively into the rearview mirror. You get a perfect, crystal-clear view of the road you've already traveled, but you have absolutely no idea about the massive pileup just around the bend. Every single mutual fund is required by law to include a disclaimer that says, in some form, past performance is not an indicator of future results. We see it, we read it, we nod our heads, and then we completely ignore it. Why? Because our brains are wired to see patterns. We see a fund that returned 40% last year, and we don't see a disclaimer, we see a rocket ship. We see a star fund manager on the cover of a magazine, and we don't see a warning label. We see a genius who has unlocked the secrets of the market. This is FOMO, the fear of missing out, weaponized against your wallet. Let me tell you a story about two friends, Mike and Sarah. They both started investing in early 2021. The market was roaring, especially in the tech sector. Sarah did her research and decided to invest in a simple, low-cost S&P 500 index fund. It was boring, but it was diversified and steady. Mike, on the other hand, saw what was happening. He saw these new flashy, disruptive innovation funds that were posting absolutely staggering returns. One in particular had returned over 100% in 2020. He looked at Sarah's boring index fund, which had done well but nothing like that, and he laughed. He told her she was leaving a fortune on the table. So Mike took a huge chunk of his savings and piled it into that one high-flying fund. For a little while he felt like a king. His account balance looked amazing. He was checking it multiple times a day, watching the numbers tick up. He was performance chasing. He was driving by looking in the rearview mirror, admiring the incredible road he'd been on. Meanwhile, 2022 was waiting right around the corner. When the market shifted, when interest rates started to rise, those hypergrowth stocks that fueled his fund's meteoric rise fell back to earth like a bag of bricks. His genius fund didn't just go down, it plummeted. It lost 60, then 70% of its value. Mike's dreams of early retirement evaporated. He panicked and sold near the bottom, locking in a devastating loss. And Sarah? Her boring S&P 500 fund went down too, but not nearly as much. Because it was diversified across hundreds of solid, profitable companies in every sector of the economy, it weathered the storm. She just kept investing her regular amount each month, buying more shares at a discount. Mike chased the past. Sarah invested for the future. This isn't just a story. It's a pattern that repeats itself over and over again. There's a well-documented phenomenon in finance called regression to the mean. It's a fancy way of saying that things tend to revert to average over time. A fund that has an unbelievably good year is often followed by a mediocre year, or even a terrible one. Why? Few reasons. First, the manager might have just gotten lucky. Maybe they made one concentrated bet on a single sector that paid off big time. That's not skill. That's a coin flip that landed on heads. Trying to repeat that is like expecting to win the lottery twice in a row. Second, the economic conditions that made their strategy work might have completely changed. A fund that thrived in a zero-interest rate environment might get crushed when rates go up. The tailwind that pushed them to the top of the charts can easily become a headwind that slams them into the ground. And third, success can be its own worst enemy. When a fund does incredibly well, a flood of new money from people like Mike pours in. The fund gets bloated. A manager who was nimble and effective managing $100 million suddenly has to figure out how to invest $10 billion. They can no longer buy small, agile companies. They're forced to buy larger, more established stocks, and their original winning strategy gets diluted into oblivion. The very success that attracted you to the fund is often the seed of its future underperformance. So if you can't rely on past performance, what should you be looking at? How do you separate the lucky from the skilled, the sustainable from the flash in the pan? You have to become a financial detective and look for clues beyond that big, seductive return number. First, look at the fund's philosophy and process. Read the prospectus. Does the manager have a clear, consistent, and repeatable strategy that you understand? Are they value investors, growth investors, dividend-focused? Do they explain why they own what they own? A fund with a disciplined process is far more likely to have long-term success than a fund that just seems to be chasing whatever is hot at the moment. Second, when you do look at performance, look at the long term and look at it with context. Don't just look at the last year. Look at the 5-year, 10-year, and even 15-year record. More importantly, how did the fund perform during the bad times? Pull up a chart and see what happened to it in 2008 during the financial crisis. Or in the spring of 2020. Did it protect capital better than its peers? Or did it fall even harder? A bull market can make anyone look like a genius. A bear market reveals who actually has skill. Third, look at consistency. Would you rather own a fund that returns 50% one year, then negative 30% the next? Or a fund that consistently returns a solid 8 to 10%, year in and year out? That wild ride might look exciting, but the steady performer often wins the race in the long run, with a lot less stress on your heart. Fourth, check the manager's tenure. This is a huge one that almost everyone misses. You might be looking at a fantastic 10-year track record, but the manager responsible for that record might have left the fund 6 months ago. The person in charge now could be a complete rookie. You're not investing in the fund's past. You're investing in the current manager's future decisions. Make sure the person who earned the gold medals is still running the race. Finally, and most critically, look at how the fund aligns with your personal goals and risk tolerance, not what the talking heads on TV are hyping up. That high-flying tech fund might be perfect for a 25-year-old with an iron stomach and a 40-year time horizon. But for someone saving for a down payment on a house in 2 years, it's a catastrophically bad choice. The best fund in the world is worthless to you if it doesn't fit your plan. Chasing last year's winner is like betting on a horse after the race has already been run. The payout is gone. The thrill is an illusion. Your job as an investor isn't to find the fund that was the best. It's to build a portfolio of funds with sound strategies, reasonable costs, and a risk profile that lets you sleep at night, allowing your money to compound steadily over the years. Stop looking in the rearview mirror. The past is a lesson, not a roadmap. But even if you do all of this, even if you pick a fund with a great philosophy, a long-tenured manager, and a perfect fit for your goals, there is still a silent killer lurking in the fine print. It's not a dramatic crash or a bad decision. It's a slow, methodical leak. A tiny, almost invisible parasite that latches onto your investment returns and quietly bleeds them dry over decades, costing you tens or even hundreds of thousands of dollars without you ever noticing. And it's the one thing that, more than almost anything else, can reliably predict a fund's future success. I'm talking about fees, the single most corrosive, wealth-destroying force in long-term investing. And the biggest mistake new investors make is ignoring them. completely misunderstanding their devastating impact. They see a fee of 1% and think, 1%? What's the big deal? It's tiny. This is not a small mistake. This is a catastrophic, multi-generational financial blunder. That 1% isn't 1% of your initial investment. It's 1% of your entire portfolio every single year for the rest of your life. It's a silent tax, an annual parasite that feeds on your growth, compounding against you year after year after year. Let's make this real. Imagine two friends, Sarah and Tom. They both start investing on the same day. They're both 30 years old, and they each invest a lump sum of $25,000 into a U.S. stock market mutual fund. Both of their funds perform identically, earning an average of 9% per year before fees. The only difference is the fee. Sarah, being savvy, finds a low-cost index fund with an expense ratio of just 0.05%. That's 0.05%. Tom, on the other hand, gets sold a fund by a friendly advisor, a fund that also tracks the U.S. stock market but comes with what sounds like a reasonable 1.05% expense ratio. It's just 1% more. What could that possibly matter? Now let's fast forward 35 years to their retirement party. Sarah checks her account. Her $25,000, compounding at 8.95% per year after her tiny fee, has grown to over $508,000. Not bad at all. Tom, feeling pretty good himself, checks his account. He earned the same market return, but after his 1.05% fee, his net return was only 7.95%. His $25,000 has grown to just under $370,000. Wait, what? Sarah has $138,000 more than Tom. Let me say that again. $138,000. That's more than 5 times his initial investment, vanished into thin air. He didn't lose it in a market crash. He didn't make a bad stock pick. He quietly paid it away one tiny percentage point at a time for the exact same underlying performance. That tiny 1% fee didn't just cost him 1%. It consumed over a quarter of his final nest egg. It was the difference between a comfortable retirement and a truly wealthy one. This is the tyranny of compounding fees. And the most infuriating part is that the industry has designed it to be confusing. The number you need to look for is called the expense ratio. It's legally required to be in the fund's prospectus, a document most people never read. It represents the percentage of the fund's assets that go toward paying for administrative, management, and advertising costs every year. It is your guaranteed annual loss before you ever make a single penny in profit. If your fund earns 10% in a year and has a 1% expense ratio, you didn't make 10%. You made 9%. If the market is flat and your fund earns 0%, you didn't break even. You lost 1%. And if the market crashes and your fund loses 20%, you didn't just lose 20%. You lost 21%. The fee always gets paid. Always. But the expense ratio is just the tip of the iceberg. It's the fee they tell you about. The second mistake is not understanding the hidden fees that can bleed you even further. One of the sneakiest is something called a 12b1 fee. This is a fee embedded inside the expense ratio that the fund charges you to pay for its own marketing and advertising. Let that sink in. They are making you, the investor, pay for the commercials and glossy brochures designed to attract other investors. It is utterly insane and it provides zero value to you. If you see a 12b1 fee listed, run the other way. Then there are trading costs. Every time the fund manager decides to buy or sell a stock within the fund, it incurs brokerage commissions and other transaction fees. These are not included in the expense ratio. So, how do you know if a fund is trading a lot? You look for a number called the turnover ratio. A turnover ratio of 100% means the manager has, on average, replaced every single stock in the portfolio within the last year. That's a massive amount of buying and selling, and every single trade generates costs that are passed on to you, the investor, dragging down your real-world returns. A fund with a high turnover ratio and a high expense ratio is like a boat with 2 giant holes in it. And finally, we have the most blatant fees of all, sales loads. These are simply commissions paid to the broker or advisor who sells you the fund. A front-end load is a percentage you pay right off the top. You want to invest $10,000 in a fund with a 5% front-end load? Congratulations, only $9,500 of your money actually gets invested. The other $500 goes straight into the salesman's pocket. A back-end load, sometimes called a deferred sales charge, is a penalty you pay if you sell your shares within a certain number of years. It's a handcuff designed to keep you in a potentially mediocre fund. The beautiful truth is that in today's world, there is absolutely no reason to ever pay a sales load. There are thousands of fantastic no-load funds available directly from brokerage firms. Paying a load is like paying a 5% fee just to walk into a grocery store. This all leads to the great debate in investing: active management versus passive management. Actively managed funds are the ones with the high fees. You're paying for a team of supposed geniuses in corner offices to handpick stocks, trying to outsmart the market. They have higher turnover, higher expense ratios, and are often sold with sales loads. Passive funds like the S&P 500 index fund Sarah chose don't try to beat the market. They simply aim to be the market by buying and holding all the stocks in a specific index. They have very little trading, no star managers to pay, and therefore their fees are rock bottom. So here's the billion-dollar secret the financial industry prays you never learn. For decades, study after study has shown that the vast majority of active fund managers, somewhere between 80 and 95% of them, fail to beat their passive index fund benchmarks over any significant period of time. You are paying a massive premium for a service that has a higher chance of underperforming than outperforming. You are paying for a 5-star chef and more often than not getting served a microwave dinner. The single greatest predictor of a fund's future success is not its past performance, not its star manager, but its cost. The lower the fees, the higher the statistical probability of a better outcome. So before you ever put a single dollar into a mutual fund, you must become a fee detective. Pull up the fund's summary page. Find the expense ratio. Is it below 0.5%? Good. Is it below 0.2%? Better. Is it below 0.1%? Excellent. Look for the words no load. Check the turnover ratio. The lower, the better. Ignoring these numbers is like setting sail across the ocean without checking to see if your boat is full of holes. You might make some progress when the weather is good, but you are taking on water the entire time, and you'll sink long before you ever reach your destination. Finding a good, low-cost fund is the mechanical part. It's the science. You can set it up, automate it, and let the magic of compounding do its work. But even if you pick the perfect fund with the lowest fees on the planet, there is one final mistake, one final enemy that can sabotage your entire plan. This enemy is more powerful than high fees, more destructive than a market crash, and more insidious than any Wall Street shark. And it's the one thing you have to look at in the mirror every single morning. That enemy is you. It's your own human nature. The final, and by far the most devastating mistake you can make when investing in mutual funds, is letting your emotions take the wheel. Fear and greed are the twin wrecking balls of wealth creation. They are the impulses that whisper in your ear, telling you to do the exact wrong thing at the exact wrong time. Think back to March of 2020. The world was shutting down. The market was in a free fall, plummeting faster than at any point in history. The news was a relentless fire hose of panic. Every headline screamed disaster. And what did your fear tell you to do? It screamed, sell. Get out now before you lose everything. This time is different. And millions of people listened to that voice. They logged into their accounts, saw the sea of red, and hit the sell button, locking in catastrophic losses of 20, 30, even 40%. They sold at the absolute bottom. They took temporary, on-paper losses and made them permanent, real-world catastrophes. They turned a temporary storm into a financial shipwreck. But what happened next? The market didn't go to zero. It staged one of the most ferocious V-shaped recoveries ever seen. Within months, it had reclaimed all its losses and was charging toward new all-time highs. The investors who ignored their fear, who trusted their plan, who maybe even bought more when everyone else was panicking, were rewarded handsomely. The ones who let fear drive the car drove it right off a cliff. Selling in a panic is like jumping out of an airplane because of turbulence, only to realize you forgot your parachute. The plane was going to be just fine. But fear has an equally destructive twin, greed. Greed is the siren song of quick riches. It's what happens when you see a fund that went up 150% last year and you think, I need to get in on that. You see your friend bragging about the tech fund that's making them a fortune, and you feel that gnawing sense of envy, that fear of missing out. So you abandon your carefully constructed plan and pile all your money into last year's winner. This is called performance chasing, and it is a surefire recipe for disaster. You are literally investing by looking in the rearview mirror. You're buying an asset after it has already had its spectacular run-up. You're buying high, with the foolish hope of selling even higher. But what usually happens? The trend reverses. The hot sector cools off. The star fund manager has a bad year. And you, the person who bought at the peak of the hype, are left holding the bag as the value plummets. Remember the dot-com bubble? People were quitting their jobs to day trade internet stocks they didn't understand. Greed was rampant. Then it all came crashing down. More recently, think of the hype around certain thematic funds in 2020 and 2021. People poured billions into them at the top, driven by incredible past returns and a story of a new paradigm, only to watch them lose 70 or 80% of their value. Greed makes you buy the story, not the fundamentals. It convinces you that this time the rules of gravity don't apply. But they always do. So how do you defeat an enemy that lives inside your own head? You don't fight it with willpower. You'll lose. You fight it with the system. You build a fortress of logic and discipline so strong that the emotional waves of fear and greed crash against it and recede. Your first line of defense is your written investment plan. We talked about this before, but this is where it becomes your savior. When you feel the icy grip of fear during a market crash, you don't look at the news. You look at your plan. Your plan, which you wrote when you were calm and rational, reminds you that downturns are normal, that your time horizon is 30 years, and that your strategy is to stay the course. It's your constitution. It's the anchor in the storm. Your second and perhaps most powerful weapon is automation. Set up automatic contributions to your mutual funds every single week, or every 2 weeks, or every month. And then don't touch it. This is the essence of dollar cost averaging. When the market is high, your fixed dollar amount buys fewer shares. When the market crashes and prices are low, that same fixed dollar amount buys more shares. You are automatically, systematically buying low without even thinking about it. Automation removes the single biggest point of failure in the entire investing process. It forces you to be disciplined when your emotions are screaming for you to be reckless. Finally, you defeat your emotions with perspective. You have to internalize, deep in your bones, that building wealth with mutual funds is not a get-rich-quick scheme. It is a get-rich-slow and steady reality. It's like planting an oak tree. You don't dig it up every week to see if the roots are growing. You water it, you make sure it gets sunlight, and you let time and the miracle of compounding do the heavy lifting. If you invest a few $100s a month into a simple, low-cost index fund and just leave it alone for 40 years, you are almost mathematically certain to end up a millionaire. It's not magic. It's just discipline and time. The daily, monthly, or even yearly fluctuations of the market are just noise. They are irrelevant to your long-term plan. Your job is not to predict the rain. It's to build the ark. And your ark is your diversified portfolio of mutual funds, your automated contributions, and your unshakable, long-term perspective. So let's bring it all home. Over these 10 parts, we've dissected the most common landmines on the path to successful mutual fund investing. We learned to stop ignoring the fine print and become obsessed with low fees, because every dollar you pay in expenses is a dollar that's not compounding for your future. We learned to stop chasing the past, to ignore last year's hotshot fund, and instead focus on consistent long-term strategies. We learned to look under the hood, to actually understand what a fund owns and why it owns it so we're never caught by surprise. We learned to find the Goldilocks zone of diversification, not too little, not too much, to build a resilient portfolio that can weather any economic season. We learned to respect the tax man, using tax-advantaged accounts and tax-efficient funds to keep more of our hard-earned returns. We learned that set it and forget it doesn't mean set it and completely abandon it, and that a simple annual checkup is crucial for staying on track. We learned that investing without a plan is like sailing without a rudder, and that a written strategy is your most valuable asset. And finally, we've learned to identify the ultimate enemy, our own emotional impulses, and to build a system of logic and automation to protect our wealth from our own worst instincts. The secret to winning with mutual funds isn't about being a financial genius. It's not about finding some secret, undiscovered fund. It is almost entirely about avoiding these unforced errors. It's about having the discipline to do a few simple things consistently over a very long period of time. You now have the map. You know where the traps are. You are equipped with the knowledge that puts you ahead of 90% of investors who stumble through their financial lives, making these same mistakes over and over again. The power to build a secure, prosperous future is not in the hands of some Wall Street guru. It's in your hands. It's in your ability to be patient when others are greedy, to be greedy when others are fearful, and above all, to trust your system. Your journey starts now. Take this knowledge, build your plan, automate your contributions, and let the incredible power of the world's greatest companies, bundled together in your mutual funds, work for you. Do that, and decades from now, you won't just be thanking yourself. you'll be changing the entire financial trajectory of your family for generations to come.